So I think that absolutely comes back. I think the bigger question and the more the opportunity for the people in this room is the floating rate or the unstabilized part of the business, and that's what we traffic in. The 50% leased office building, the empty mall, the tougher stuff, you know, where that was the province of the CDOs, and the CDOs just took all that, threw it in there, and made money off that. I don't think that's coming back, you know, for some time, and I think you're going to see that end up more as a province of private lenders and banks with recourse. I'm not sure Wall Street's going to be back into that game, you know, for a little while. And then moving over, which we haven't really talked about, or I heard a lot talk about, is for sale properties, land, condos, and home building. And we're actually very active in those areas right now because there's some real true distress. And there's where discounts are being had. And a lot of that is happening, which we really haven't seen yet, is at the regional bank level. These regional banks and community banks are just now starting to, you know, come to their problems. And you're seeing now discounts being offered on notes and on land, on condos, on finished homes. So I think you have when you say where's lending going, I think Bob is right on the fixed rate side, but I think it's a whole different ball game on the unstabilized stuff because I don't think Wall Street's coming back into that, and certainly is a whole different ball game on land and for sale, because even the CDOs were doing that. The CDOs all had a junk bucket for 10%, and they were making land loans at 250 over. Well, that's gone, which it should be. But there's a lot of people who were caught long on these deals, and they're all coming due, and they're all coming out of interest reserve. And there's going to be a lot of opportunity either to make new loans at lower basis, recapitalize them, or to buy discounted paper. And that's the kind of thing we're looking at.
So if somebody's got something in the room that you'd like, what would you tell them to come on down with?
Well,
what would you like to see?
I like anybody who has been served a foreclosure notice can come see me. We like those people. We like to take our capital to illiquid borrowers or illiquid markets or illiquid properties, and that is where we think we can lower the basis, and time is on our side.
Now, your company, Michael, iStar Financial, I love them, because when you go into them, I like Lehman too, but iStar Financial, when you go into them, they say, what kind of deal you got? What kind of deal? I can make any deal you got. I can do mezz, I can do firsts, I can do dequity, equity, right?
With our short funds these days. No, I think
You used to be able to do that.
Well, I think that we, like lots of other people in this business, have been operating under liquidity constraints. We haven't done much in the way of new originations this year, if you don't count rolling existing loans.
Michael, talk a little about iStar.
iStar is a publicly traded real estate finance company. We're about $6 billion in assets. We have loans across the entire spectrum, as Barry suggests, from first mortgages to mezzanine. I think we were one of the original engines of creating the mezzanine market before a lot of people came in and ruined our parade. We have done various secured, highly structured transactions where there may be several tranches to that. We may play in a particular tranche. We spend a lot of time trying to figure out where the best risk reward is in the capital stack, and then go aggressively into that sector. We have been contrarian generally in a lot of the things that we've gone after. We try to look under rocks where other people aren't playing, simply because we think that, a lot of the world paints a picture with a broad brush and misses some opportunities just because of not really willing to do the heavy lifting of the underwriting to understand where true risk reward is. We were originally a firm that did a lot of mezzanine transactions. As we grew to a size where we could issue unsecured debt and became an investment grade borrower ourselves, we were able to take down entire envelopes of transactions. That would be eliminate an intercreditor agreement. That was kind of a novel concept at the time, and we were able to make hay doing that for quite some time. Those of you that have dealt with intercreditor issues know what I'm talking about. There was a premium people were prepared to pay to have a one-stop shop, and we were happy to provide that capital. We were also generally a large loan player, and so we would be fairly aggressive in the $100 million up area. And by aggressive, I mean chasing the transactions. Most of the people on this table know we're not the lowest cost provider of capital in the world. But we, I think, do provide a high degree of service, and unlike the structured finance world, if there's an issue in your deal, you know who to call. We're on the phone. We service all of our transactions internally, whether it's a construction loan or a standalone income-producing property transaction. I think that as we look at the landscape today, there are going to be a lot of opportunities. The market has come back to us. CDOs who ruined our game are gone, and for lots of good reasons. Shouldn't be making mezzanine loans to 95% of the capital stack at 450 over. Just not right. You know, the unfortunate part is liquidity constraints make it harder for us to be a one-stop shop. You know, we can't take down an entire capital stack because we'll spend $1 billion in no time, and we have to go find that $1 billion in the capital market just like everybody else does. We watch closely what's happening in the unsecured debt capital markets because that's our source of continual access to capital. That market is starting to get better, but you know, real estate plays in the same capital markets as every other consumer of capital today. And so when subprime gets a hiccup, corporate debt gets a hiccup, LBOs get a hiccup, Europe gets a hiccup, Asia gets a hiccup. It goes everywhere. There's no isolated islands anymore in the capital markets because everybody plays everywhere. And so when one aspect of, in particular, the subprime caused problems, you immediately started to see problems in European banks because they bought a lot of the subprime securitized debt. Well, then suddenly they became